Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 10, which is about corporations, paid-in capital, and retained earnings. Let me go down. Here we go. Come on. All right, there we go. So for this video, this here is going to be the introduction for the theory for this chapter. Before I get started, if you haven't already realized, the textbook so far has gone. It started out with 3 chapters on how to keep books, okay, the bookkeeping aspect of it, and then we went over a lot of the stuff that has to do with assets, and then we went over things that had to do with liabilities, and now we're going over things that have to do with equity, basically the accounting equation, okay? So from an overall view, that's, high level, that's kind of like where we're at right now, in that, you should have a pretty good grasp of assets. You should have a pretty good grasp of the things that have to do with liabilities. And now you're going to work on, things that have to do with equity. And to be honest with you, this here is not that difficult, at least from my perspective. There's not that many items to basically deal with when it comes to equity. It all depends upon the structure of the business. If it's a sole proprietorship, well, then you're going to have a capital account as part of your equity. If you're a corporation, which is what we're going to deal with here, basically there's stock, okay? And of course, with stock comes an account retained earnings, because that's where your profit or loss goes. But we'll get into that in a bit, all right? So in this introduction, what we're going over in this chapter is we're going to discuss how corporations are organized, and I'll get into that after I finish this list. That'll be just part of the introduction, because it's, you get into a lot more detail when we start talking about common stock, preferred stock. Then we'll cover, dividends. That's the return on investment for your stock, if it's paid out or not. And then we'll talk about dividing um, the dividends between common and preferred, and the concepts of cumulative and non-cumulative. Right? Uh, this is probably the most complicated aspect of the entire chapter, because you do have to do some calculations or figuring out, and it all depends. Each and every situation is very different. It's not, again, it's about understanding concepts and applying it to the situation. It's not cookie cutter. You're going to be given or shown an example of this idea of dividing between common and preferred, and you'll be shown what cumulative and non-cumulative means. But each and every business makes the decision as to how they're going to divide up their dividends. And it's not, no two are alike. And even if it's within the same company, all right, that can change over time. So it's sort of like doing payroll, where, yeah, you understand how to do payroll, but payroll is individual. Doing payroll, if you have 180 employees, you have to look at, kind of like from the perspective of, I'm doing payroll, 180 different times, and then combining them all together. There's just no one set way that, as a template for everything to fall into, right? But we'll get into that when we get into that particular video. Then we can also discuss stock dividends and stock splits. We'll cover something called treasury stock, which is company buying back the stock. And we'll take a look at reporting, how it's shown on the balance sheet. And then the focus on decision making, just like at the end of every chapter, there was, ratios that you use for analysis. And this particular chapter basically only has one formula that you have to take a look at. So we'll cover all of that in the future videos in this series on the theory. So let's go down here to how corporations are organized. Right. Before I talk about corporations, just a quick little background, all right, to try to set things in place, all right. Some businesses will immediately start up as a corporation, all right, because of the size that they think they're going to be, all right. Um, that happens a lot, all right, and realize that there are different types of corporations. There's an S corp and a C corp, all right. But we're not going to get into the different types of corporations. That's a more in-depth. Remember, we're looking at a high-level view here, okay? But I'm going to kind of like in this high-level view, I'm going to present this as, let's say, actually, you have a sole proprietorship, you have corporations, all right? You have uh, LLCs, limited liability companies, okay? You have a variety of different ways of setting up your particular business, okay? Now, let's just say you decide to make, I don't know, walking sticks, okay? And so, you sit there and you carve out one walking stick and another one, okay? And you take it, to a flea market, say, okay? And when you go to the flea market, you sell the walking sticks. So you had to buy the wood, all right? You had to buy the tools, all right? You make the walking stick. This is a walking stick, all right? Uh, and then you take it and you sell it and you get money for it, okay? So theoretically, you should be making enough money where you have a profit, okay? Um, if you do your taxes as a sole proprietor, you're going to probably put it on your taxes as a Schedule C, right? In order to record your revenues that you get for selling those walking sticks. Now let's say that for whatever reason you those walking sticks are very, very popular, okay, and now you're really making some big bucks. I mean, you're selling quite a few. Somebody sees them and they decide that they want you decide that you're going to go into some type of mass production in order to sell them. Well, now you're going to make, it probably makes sense for you to create a corporation because you have um, increased, your production. You're going to have a lot more transactions, and you really don't want to have any liabilities come back on you personally. As a sole proprietor, right, you are anything that happens comes back on you. But by creating a corporation, you're setting up a separate entity, and as long as you follow the rules, um, no legal liabilities. If somebody gets hurt, they can't come back on you and take all of your personal assets. Okay, if it's done through a corporation. If you're a sole proprietor and somebody gets hurt, they're able to sue you and take everything you own. So you set up this corporation in order to separate yourself from the business. Okay, you run the corporation as if you're a sole proprietorship. I mean, you make the decisions, things like that, but there's, you basically set yourself up where you have separate yourself from legal liabilities. Now, of course, there's other ways of doing this. There's partnerships, there's the limited liability companies, and these are all other different entities. They're all tools, and you should consult a tax accountant a- and a tax lawyer before you decide to do this. Decide which entity that you should be set up as, all right, because each and every situation is different. I'm sitting here and my mind is racing and I'm stuttering because as I write something, I get all of these here, you different ideas where, oh yeah, in this instance I would do that, in that instance I would do that, something different, that type of thing. So, um, just realize that that's what we're looking at from a high level. It's like going from a sole proprietorship and saying, okay, the business is large enough. I want to separate myself out so that I'm not legally liable personally, and nobody could come back and take all of my assets. Right. So um, in this chapter, we're going to just strictly talk about corporations, and I'm not going to be setting out whether it's an S corp or C corp, because these are different entities. Okay. And it's just a matter of you're talking to your tax accountant. Just be aware that things like that are they're out there. Right. But when you set up a corporation, and I suggest that I'm not going to spoon feed the beginning of the chapter to you. Read the first few pages in the chapter, which covers a lot more terminology as far as the setup is concerned. I'm just kind of like going to go give you an overview right now. Again, high level, all right, from what we're talking about, and then based upon what we move into the next video where I start talking about common stock, preferred stock, it'll just progress and get um, a little bit more in depth as far as stock is concerned. So when we set up a corporation, there's rules. All right, you have to have articles of incorporation. Okay, it's a formal document that you set up when you set up your corporation, and in that document, it basically says, okay, how many shares of stock are you authorizing, all right, to be able to sell? Now, the idea here is that you want to set a price on stock, and let's just say, and I'm to keep numbers simple, let's say it's $1 a share. Okay, you want to set the number of authorized shares of stock that could be sold, not necessarily will be sold, but could be sold. You want to set it at a bar that's so high that it's most unlikely that you're ever going to use it. Let's say you have an air conditioning refrigeration company. You do some HVAC repair and you decide to set up as a corporation. And maybe you might have 5 or 6 employees, service people working for you. You can set up authorize 1 million shares, realizing that 1 million shares at $1, okay, realizing that you're never going to use that 1 million shares. I mean, you're basically treating the HVAC business as a family-owned business, right? Because you own it, but instead of being a sole proprietor, you're deciding to you decide to create the corporation, all right, in order to separate yourself legally from that entity, okay? So that if somebody sues, they come back and they're going to attack the corporation. They're not going to come back and attack your assets personally. So you set up the authorized stock of 1 million shares, okay? But maybe you purchase 5,000 shares of the stock, right? Right. So if it's 5,000 shares at $1 a share, you're investing in the business $5,000, okay? And you're the majority shareholder, okay? So the outstanding stock is that the number of shares, the 5,000 shares um, that have been purchased. That's what's outstanding, and that's what's been sold. Okay. Now you're the major shareholder. You control it. You control that business. And for a small business, you're not going to really go and sell shares to other people unless you're growing and you need the money. Okay. And if that's the case, then you have to start thinking about um, maintaining your majority of shares, meaning you have to invest more money in the business. But you may have to give up control depending upon how big you want the business to be. Okay. If you're going to put on a new edition and you need, $2 million, right, of in order to invest in the business. Well, you don't have $2 million. In order to build that edition, you don't have $2 million. So you're going to have to you would go out and possibly sell stock, and of course you're going to give up control if someone else buys more shares than you have. Okay, but that's all getting into something different there. I'm not going to get into into in-depth in that. What I want you to just realize at this point in time is that when you set up the corporation, right, you create an articles of incorporation which tells how many shares of stock can be sold, in the business. Then the purchase of that stock is the number of shares that are outstanding. Now, those shares that are outstanding um, are broken down into common stock and preferred stock, two different classes of stock, which I'll talk about in the next videos. And then if a company, decides that they want to buy back some of that stock off of these shareholders, okay, that's the shares that they buy back becomes treasury stock. Okay, so where we're standing at right now, the important thing is to realize is that read the first few pages of the chapter and realize that we create articles of incorporation when we need to set up the corporation. In those articles, it tells us how many shares of stock are authorized, but that's different from the number of shares that have actually been purchased. And we'll get into all of that as we move forward into the rest of the theory videos. But those shares of stock that are purchased are is our outstanding stock, and that's broken down into common and preferred. And then of course we can buy back some of that stock, and generally that helps boost the price of the shares of stock, and when we buy it back, that stock is called treasury stock. Okay, so this is just a basic high-level overview to start giving you some ideas to what we're talking about. As we move forward, we're not going to talk about the articles much anymore. Yes, we will talk about authorized and outstanding, but we'll be discussing those in conjunction with when we're talking about the common and preferred stock. Okay, those concepts are integral parts of common and preferred stock. So in the next video, we'll start to move into actually the common stock and the preferred stock and start getting into a little bit more detail as to what that's all about. So I'll see you in the next video.